attending the session entitled The New Auditors Report. Before introducing our distinguished panelists, let me first of all give you a brief overview of this session. I would like to invite you to embark with us on a journey providing insights on the rationale behind the recent actions aimed at establishing a new auditors report. We will be provided with an update on the recently approved new and revised license, subject to approval from the Public Interest Oversight Board. The new and revised auditor reporting license are scheduled to be released in January 2015 and will be effective for audits of financial statements for periods ending on or after December 15, 2016. Early adoption is permitted, and we see an increasing number of clients discussing with their auditors the potential implications of the new and revised standards on the auditing reporting process. And we will also hear about developments in the United States, take into account the PCOB release dated August 13, 2013, and the public hearings that were held in April this year. And as the chair, it is now my pleasure to introduce to you the panelists. Let me start certainly with the lady first. We welcome Professor Linda de Beer. Linda is a chartered accountant by profession and acts as a non-executive independent director on a number of company boards, most also chairing the audit committee. In addition, she's a visiting professor in the School of Accountancy, University of Witwatersrand in Johannesburg, South Africa. And we welcome Marty Baumann, PCOB, Chief Auditor and Director of Professional Standards, Office of Chief Auditor. Marty joined the PCOB in 2006 and served as Director of the Office of Research and Analysis before becoming Chief Auditor. Marty led the effort to complete Freddie Mac's restatement and improve its financial reporting when they were in trouble. Big effort, Marty. know that, even not being US citizens. Earlier, Marty spent 33 years at PricewaterhouseCoopers, and Marty is a certified public accountant. Coming to Dan Montgomery, IAASB Deputy, that has served on the IAASB since 2009 and had led the board's project to improve auditor reports. He's a senior partner in the Global Professional Practice Department of Ernst & Young and has nearly 40 years of experience with the firm. And now, Philip Johnson. Philip was senior partner in Deloitte UK and president of the European Federations of Accountants, FEE, in 2011 and 12. And he is currently a member, I think Philip was the first European of the Standing Advisory Group of the PCOB, which I think is really rare. And in addition, Philip is the chairman of the Audit Committee of Yorkshire Building Society, and you're a member of the Audit Committee of Wellcome Trust. And my name is Michael Weir. I'm a member of the Fee Auditing and Assurance Policy Group. So, we would like to start with the question, why change the auditor's report now? And Philip, would you mind to start and share perspectives with us based on developments both in Europe and notably in the UK, which is part of Europe, by the way, but ahead of the pack, so please.
Thank you, Michael. It is an interesting question, why change now? Going back to 2007, it all started with a financial crisis, and I know that too well because I went up to the board of a financial institution in the summer of 2007. And we found in the UK that Northern Rock collapsed, and then it was then followed by Lehman Brothers in the US. And so the financial crisis moved quite quickly to a global economic crisis. And as a consequence, the politicians decided that they wanted to get involved. And politicians want to get involved because of changes in public sentiment. And there was clearly a change in public sentiment in Europe. The accountants and auditors weren't blamed for the financial crisis, but they were questioned as to why they didn't raise more and more questions about business. And they were actually referred to as the dog that didn't bark, because people couldn't understand why there were clean audit opinions issued, and then quite quickly there were major issues, particularly in the financial services sector. So the politicians looked at the audit profession as a whole in Europe, and there was this there was always this question about what did auditors do. There was what was referred to as an information gap. As I referred to it as an information gap, others thought it was an expectation gap. But I think it was an information gap, and as a consequence, people wanted to know what auditors were doing and have insight of what happened in business. So in 2010, October 2010, the European Commission issued their infamous green paper, which really started the world looking at what was happening. But I'm not going to go into details of that because it's many in this room will have followed that debate. And that debate was finally concluded this summer. It did take 4 years to go through the legislative process and the discussion process, but finally the European Parliament did create a new directive, a new regulation, and that will come in a couple of years' time in all member states of the European Union. But what also happened was, because of the political pressure in many countries, some of the countries decided that they would move forward at a more rapid pace than they could see the European Parliament moving. They wanted to move at a more rapid pace than the standard setters were moving, and so they brought in legislation in their own countries. Poland was one of the first, and they decided that they would bring in mandatory audit firm rotation for financial institutions quite quickly, but they didn't go any farther than that. But there were two countries that really in Europe that did decide to take the lead, and one was the Netherlands. And in the Netherlands, they adopted quite early in the process the new IAASB reporting proposals, ISA 700, at an early stage during the time of development, and Dan will cover that. And they also introduced one or two other proposals with regard to the Green Paper. But in my own jurisdiction, the United Kingdom, the FRC, who is the regulator, issued amendments to what is the current ISA 700, which meant auditors had to provide more information in their audit reports for public interest entities, in particular regarding significant audit matters as they were described, and what the auditor had done, and what work had been undertaken with regard to those matters. They also introduced the requirement to disclose the level of materiality that the auditor was working to, and the requirement to comment more extensively on the going concern concept. And so there was much more focus on providing information of what the risks were within the audit, how the auditor had dealt with those risks, and looking at, as I said, the going concern. But at the same time, within the United Kingdom, because there is only one regulator for corporate governance and audit standards, the FRC also brought in requirements on audit committees And that probably made the transition on auditor reporting easier, because the audit committees had to do additional disclosures. And so I think that was very, very helpful. We'll touch on that more later. The new requirements in the UK, they came into operation for year ends commencing on the 1st of October 2012. So we've had one full year of the new reporting regime. We're just going into a second year of the new reporting regime, and that will be interesting to see how the developments have taken place when it's second time around rather than just first time around. And I think it is important that we now see this sea change that's happening around the world, in particular now with the IWSB running issues, ISA 700 in the near future. It will affect over 100 jurisdictions. So the world of auditor reporting has changed. So it's not a matter of why change now. I think it has changed. I think the sentiment's changed. And I think now we should embrace that as a positive move for the profession, because it makes the profession far more relative to what is relevant and relative to what is happening in the marketplace and around the world. But my final comment would be that the auditor cannot work in isolation. There has to be a similar movement in financial reporting and corporate governance reporting to really make it that transparency within corporate reporting in its entirety.
Okay, thank you. Marty, could you give us some views on the light of the PCOE's project on auditor reporting?
Sure, I'd be glad to. I guess the question that you asked before about why now, I might paraphrase that a little bit to say, why has it taken so long for the audit report to change? The audit report, at least in the United States, has essentially been the same report since 1940 or so, and there aren't too many products that exist unchanged for that period of time. So over the years, there have been a number of commissions in the United States that looked at the audit report and suggested the importance of changing that report. The last one was in 2008, really before the beginning of the financial crisis, and that was the U.S. Treasury's Advisory Committee on the Audit Profession. And one of their major recommendations was for the PCAOB to study the audit report and look at potential changes that could benefit investors if we went ahead and made changes to the report. So, and certainly I will agree with Philip then that the financial crisis then became a strong impetus to move forward with that change recommended by the Advisory Committee on the Profession. Many felt that it would have been useful if the audit report, rather than just saying the financial statements presented fairly or not, if preceding the crisis, the audit report indicated in one way or another some of the important issues that the auditor was dealing with. In that way, maybe some of the investors and others could have been put on notice of some of the risks that led up to the crisis. So I'm not suggesting to say that an improved auditor's report would have prevented the financial crisis by any means, but it certainly could have alerted various investors or regulators to issues that were really troubling the auditor during the audits of certainly financial institutions in particular, maybe some others. I can think, for example, if the audit report talked about, let's say, banks that were originating mortgages that required no down payment, which was suddenly what was happening in the U.S., the auditor might have indicated in the audit report the allowance for loan losses was very difficult to audit because there were new products being offered where traditionally mortgages required a down payment. Now they didn't. So there was no credit history upon which to base the allowance. So things like that could have put investors and our regulators on notice of some of the challenges. So why change it now? I think it's long overdue for change. The financial crisis has demonstrated a need for it. And then I'd say the continued evolution towards fair value measurements and more complex accounting estimates furthers the need for the auditor to talk more about the audit or the financial statements, we'll get into that a little bit later, so that the auditor, rather than just saying the financial statements present fairly, gives investors and other users of the financial statements more perspective on the work that he or she did and on the more complex areas that he or she dealt with. So I think the time has come to change. Thank you.
Linda, you being the chairwoman of the IWSB CAG, you probably also have insights on prospective investors and many other stakeholders in the financial reporting change, such as preparers, regulators, audit committee members, etc. What are your views on that?
Thank you, Michael. And yes, the CAG is a very broad-based organisation because we consist of about 30 or so different organisations, regulators, preparers, investor community, as you said. So my perspective is quite broad and coming out of that group of people. And I think probably 3 points, and some of those were made possibly in a different way already. Firstly, the audit report is very binary, as we know it. It's a pass-fail. In South Africa, we call it a robot. In other countries, we call it a traffic light. So it's either a green light or a red light, or possibly an amber in the middle. And investors in particular were saying that as an auditor, being an agent of the shareholder, because the auditor really works for the shareholder, the auditor is in a very unique position where they have a lot of insight into the business, and it would be very useful for shareholders to be able to look through the eyes of the auditor in understanding the audit issues, the risk areas, the difficulties a bit better, and in doing so, obviously having better insight into the company and its financial statements. And that's why it was really necessary for change. And then, if I could just add on to what Philip spoke of, and he spoke a bit about the financial crisis, it was questioned post the financial crisis whether the audit report shouldn't have acted as a little bit stronger early warning system. And there are lots of debates around that, but also maybe some insight through the audit report, because that's the only product that the investor can see coming out of the audit, on what some of the difficulties are, some of the risk areas, the audit risk areas and so on in the business. So it was definitely due for change to get greater benefit and greater value from an investor perspective, and certainly also from a regulatory perspective.
Thank you. Dan, please share with us views and give us information on the status, public, prospective benefits, etc., of the project you've led.
Yeah, thank you, Michael. And I would just add to some of the comments that have already been made by other panelists. The IAASB started its project back in 2006, and at the time it was focused on academic research, looking into the perceptions of users of the standard auditor's report, the usefulness of the standard auditor's report. And the message that was received was that users found the auditor's report valuable, the opinion was valuable, but in fact the rest of the auditor's report was viewed as no more than standardized language and not very informative. So this consistent message was heard by the IAASB throughout the course of its project, and that included free public consultations, direct outreach, roundtables, discussions with key stakeholders around the world. And so the message was increase the informational value of the auditor's report, but don't change the binary opinion, don't change the pass-fail nature of the opinion. As others have mentioned, these calls were changed and accelerated in the wake of the global financial crisis. There was greater demand from investors and other users for more transparency about the audit that was performed. the audit was being viewed increasingly as a black box. And when you couple that with the fact that financial reporting was becoming more complex, financial reports were becoming longer, in some cases much longer, with more qualitative and narrative type disclosures, users understood that auditors had great insights from performing the audit and had asked auditors to share more information about the audit that was performed in the auditor's report itself. And it's not for the purpose of providing information that management is responsible for providing or may not have provided. It's simply to help users better understand those the more significant areas of the audit and how the auditor addressed them, so that they in turn can spend more time focused on those areas in a financial report and engage in greater dialogue with management and those charged with governance. I would say that the financial crisis also triggered some key questions about audit quality. And there were questions about the overall effectiveness of audits, the application of professional skepticism by auditors. So more broadly, the belief was that changing the auditor's report, the primary vehicle that the auditor has for communicating with users of the financial statements, that change was essential to maintain the relevance of the audit and confidence in the audit profession globally. So, to sum up, the overall message was change is needed, it is essential, and it's needed now.
Thank you. Well, we would now like to give you an update on international developments. What is the intent behind the changes to the auditor's report? What is similar and what is different? Yeah? You've heard the terms, perhaps, key audit matters, yeah, critical audit matters, significant audit matters, yeah, that will all come into play. And then, yeah, talking about international, sorry, it's again up to you to start first now, yeah, and perhaps, yeah, you can a bit summarize the key improvements, yeah, of the forthcoming standards, yeah, and also the new standards, yeah, ISO 701 on communication of key audit matters. I think this is to the heart of every one of us, yeah.
Yeah, indeed, thank you, Michael. And just as a starting point to let everyone know that this package of new and revised standards was approved by the IAASB in September, this past September. And it's, as Michael, as you mentioned earlier, it's awaiting approval of the package of standards by the Public Interest Oversight Board and expect to be released in sometime in mid-January of next year. The changes to the standards, certainly ISO 700, the baseline auditor reporting standard, will change, along with a new standard, ISO 701, and I'll touch more on that in just a moment. And then some other changes to the other reporting standards, as well as other standards like ISO 570, ongoing concern, and ISO 260, communications with those charged with governance. Perhaps the most significant aspect of the project, often referred to by some as the crown jewel of the project, is this new standard ISO 701. And it provides requirements and guidance for auditors for communicating key audit matters. It will require that a section titled Key Audit Matters would be included now in auditor reports for listed entities. The IAASB elected, for some very good reasons, to start initially with listed entities, but recognize that law or regulation in different jurisdictions may require a broader application to, for example, to public interest entities, or an auditor, in fact, could choose to communicate key audit matters on a voluntary basis for non-listed SME entities. So what are key audit matters? As defined, and first and foremost, these are matters that are selected from those matters that the auditor communicates with those charged with governance. And they are the matters that, in the auditor's professional judgment, were of most significance in the audit of the financial statements of the current period. Though in determining key audit matters, the auditor first focuses on the areas that require significant auditor attention. And to provide a framework for that determination, the ISA requires consideration of certain factors. Interestingly, these factors were developed, at least in part, based on feedback from investors and other users about the matters that would be of most interest to them. So those, the three required considerations are areas of higher assessed risks and material misstatement in the financial statements, or significant risks, significant auditor judgments relating to areas of significant management judgment, for example, complex accounting estimates, and then the effect on the audit of significant events or transactions. So in most cases, it's expected that key audit matters would relate to significant or complex matters disclosed in the financial statements, impairment, valuation of financial instruments, other areas with estimation of uncertainty, revenue recognition, and the like. Importantly, however, key audit matters are not limited to matters disclosed in the financial statements. There could be another aspect of the audit, for example, a significant system implementation that required a great deal of auditor attention during the audit, and the auditor may choose to communicate that about that as a key audit matter. Within the key audit matters section, the auditor would describe each of these matters using an appropriate subheading, and the description would include why the matter was believed to be one of most significance in the audit, as well as a little bit about how the matter was addressed in the audit. And the key point here is there's a fair amount of flexibility for auditors in terms of the nature and the level of detail provided in the description. But investors and other users were very clear to say that they wanted more than just a pointer to a disclosure in the financial statements. They wanted something from the auditor to describe the auditor's insights about how they approach the matter. A key question that has been asked is whether all matters that meet the definition of a key audit matter will always be communicated in the auditor's report, and the answer is not necessarily. Respondents indicated that auditors should have some flexibility to not communicate a matter if it meant that the auditor would be providing information that otherwise was not previously disclosed by the entity. And it relates to broader concerns that had been shared throughout the project about the auditor providing original information about the entity. So ISO 701 will require all key audit matters to be communicated unless law or regulation precludes public disclosure about a matter, probably limited in circumstances. And then also, in extremely rare circumstances, the auditor determines that the adverse consequences of communicating a matter would reasonably be expected to outweigh the public interest benefits of that communication. So the expectation is that there is a public interest benefit for users to know about all key areas of the audit, but there may be some more sensitive type matters that the auditor could decide not to communicate. Another aspect of the new or changed auditor's report is more focused on going concern. I would say, to start with there, that in the course of the project, the IAASB stakeholders expressed a need for more attention to going concern. And to address that point, the IAASB initially proposed that there would be two explicit statements, conclusion statements, if you will, in the auditor's report about going concern. However, commenters on the IAASB's exposure draft had mixed views about the benefits of those explicit statements. and it's instead asked for a more holistic approach to going concern that involve both accounting standard setters and auditing standard setters. Encourage the IAASB to work together with the IASB and others, and in fact the IAASB had active dialogue with the IASB, also followed the developments of the US FASB. However, the IASB concluded not to pursue a going concern project. So the IAASB still believed that auditor reporting on going concern was in the public interest, concluded that now was not the right time to include specific statements or conclusion statements in the auditor's report. So the emphasis on going concern comes in three ways. One is when a material uncertainty relating to going concern exists, there will be a required separate section of the auditor's report that would have an appropriate title to call attention to that material uncertainty. There would be an expanded description of the responsibilities of both management and the auditor for going concern. And then finally, a new requirement for the auditor to challenge the adequacy of disclosures in what we call close call situations, where the auditor had expended a great deal of effort dealing with events or conditions that could lead to significant doubt about the ability to continue as a going concern, but the ultimate conclusion was that no material uncertainty existed. A couple of other aspects of the project. There will also be a required section on other information when other information applies. The auditor reporting aspects are being addressed as a part of a separate IAASB project to revise ISA 720 on other information. And when that project is finalized, the effective date will align with the auditor reporting standards. Finally, a couple of words about some other improvements, including the form and structure of the auditor's report and some other improvements to enhance transparency or clarify responsibilities. The first thing you will notice is that the auditor's opinion will be required to be presented first in the auditor's report. Investors and other users were very clear that they placed a high degree of importance on the auditor's opinion, and therefore the board decided that it should be given prominent placement. In fact, that section would be first in the auditor's report. There will be a requirement to disclose the name of the engagement partner responsible for the audit. That will be for listed entities. There will be a required statement that the auditor is independent of the entity in accordance with relevant ethical requirements.
Second season, it's all about better reporting rather than more reporting. I think we have to be careful that we don't end up with a whole raft of issues that are presented. And as Dan said, it's not necessarily everything that's put in front of the audit committee and whatever everything that has started has been potential risks as far as the audit is concerned when they're undertaking the audit. So I think what we found is that in the second round, people are being more selective as to what they want to start doing. And I only know that from experience on the two audit committees that I sit on, we're as audit committees are talking about giving better and more detailed disclosure for fewer points rather than having a whole raft of points that's out there. So I think that is helpful. If you look at the studies that you mentioned, it is quite clear that there's a whole range of different types of disclosure. There's some companies, the audit committee report is 3 pages long, and the audit report is 6 pages long. And then you've got others that are the opposite way around. So I think we're in a process of iteration, that it's developing. And I think that what it will do is provide more information to the investor, to the investing public, as time goes on, and it will develop over that period of time. And when you look at, I know that Marty's going to talk about the PCOB. The IWSB is more principles-based. It's a relatively short standard. It's not prescriptive. So there are certainly obviously the requirements. So I think there is more. There is the opportunity for the auditor under the ISOs to really form their judgment, and I think that there will be better quality reporting rather than just more reporting. I think that is important.
Okay. Marty, as we said, the PCOB applies to concepts of critical audit matters. Can you give us some more insights on that? And perhaps the way ahead, what will be the next steps envisaged by the PCOB?
That's a good question. So why don't I talk a little bit about the project history as well in the United States. We started out some years ago with a concept release, really trying to explore what investors and other users of the financial statements really wanted in terms of change. And it really was a very broad answer. The investor community and the user community want a new audit report in the United States, but they wanted to change a lot. Many of them really wanted information about the financial statements. The financial statements are often portrayed as very exact numbers on the balance sheet and the income statement, but there's knowledge that there's wide degree of measurement uncertainty in many estimates or fair value measurements. And so investors really wanted to hear where on the spectrum of reasonableness did management come out with their judgments? Were they conservative or aggressive in their accounting? And that's really what investors said they wanted to hear. On the other hand, preparers of financial statements, corporate America, insurers, really didn't think there needed to be a change in the audit report at all. And the audit community believed it was time for change and was somewhere in the middle of those two as to no change or very radical change. And so the proposal that we issued in 2013 that you referenced dealt more closely with dealing with matters about the audit, but dealing with matters about the audit in such a way that it would shed sunlight on those issues in the financial statements where there were measurement uncertainty. So those issues in the financial statements that were the most complex, most subjective areas of management judgment, so that the auditor would discuss those matters in critical audit matter section of the audit report, and not directly, therefore, talk about the financial statements, but talk about the audit, but pertaining to those matters. Really the difference between key audit matters or significant audit matters or critical audit matters in the U.S. is more terminology of jurisdictional language that's familiar in each regime. The United States, people are familiar with critical accounting estimates and critical accounting policies, which are required disclosures of corporations. So we had a public hearing, as you mentioned, in April of 2014, and we're now in the process of preparing a re-proposal, which we expect to put before the board in early 2015 to get further comment before we finalize it. I believe it continues to be along the same lines that Dan has discussed and what's happening in the United Kingdom. In my mind, again, for board approval in early 2015, we would continue to talk about critical audit matters, and they would be matters, and this is important because preparers are concerned about this, that do pertain to the financial statements, that are not things outside of the financial statements. So critical audit matters would be those things that involved the most significant, complex judgments on the part of the auditor in dealing with financial statement matters, and they would pertain to matters that were material to the financial statements. So if something was not material and was not otherwise addressed in the financial statements, at least in my view, in order to meet kind of the balance between what investors want and what preparers are willing to accept, it probably has to be about things that are material to the financial statements. But that's subject to the re-proposal in 2015. We also have an aspect of it dealing with the reporting on other information accompanying the audited financial statements. The auditors historically read that other information, but investors really have no insight into that. And so auditor reporting about the other information is also valuable in saying that the auditor read that information, and if there are any material inconsistencies between the other information and the financial statements, or between the other information in the document, if there's a material misstatement of fact that comes to the auditor's attention, that should be discussed with the client and the audit committee as necessary, and if not resolved, reported in the audit report. So those are key changes, but again, I do think there's more similarities than differences between the developments in the UK, the upcoming ISA, and where we're headed in the United States.
Thank you. And do you agree with our learned is, I think in my view, that it is many terminology and that it is tailored to jurisdictional aspects. So the Americans are used to critical in the various aspects, whereas internationally we say key, and in the UK, well, I haven't seen any great difference. Can investors, can preparers, let's say, overcome that complex linguistic situation?
Michael, I guess in the ideal world it would have been perfect if the terminology was exactly the same. Having said that though, I think yes, a very important message that came through all along this project from the investor community was that they're not worried about the volume of information. They're not worried about the audit report being longer. They're interested in the quality. So if the information is useful, whether you call it a key audit matter or a critical audit matter or anything alike, if the information is useful, they would rather like to have it there. So the ultimate objective should never be to make it as short and concise and possibly as boilerplate as possible. I think the success of this project and the success of where all of these things are going on auditor reporting will also hang very strongly on whether auditors will be able to make it entity specific. Because if you find that auditors now end up having, let's call it key audit matters per industry, that also will take away from the decision usefulness of the information. And I believe in the IASB side, in drafting the standard, there were a couple of checks and balances built in to try and force the auditor to think about it very specific to the entity, which I believe would be really useful. And maybe the one added benefit or the big change in my view, and certainly a matter that we discussed at the CAN, was that because auditors will be disclosing really important information about the entity through the eyes of the audit, there is an added, maybe unintended benefit that it should enhance the quality of reporting by the entity. Marty, you spoke about the preparers actually saying that they didn't think it was necessary, but and which is true, and there's certainly some of the views that we saw. But certainly the entity wouldn't want the auditor to be providing information in the first instance. So there is this benefit that hopefully companies will enhance their own disclosure and that the auditor can refer to that, which in the end is to the benefit of the investing community.
Thank you. Well, I think we all know that major enhancements, and I think we have heard, and it has been made very clear by the panelists, that the new audit report regime is a major enhancement. And what Marty said is, since 70 years in the US, it's the first major step.
Enhanced derivative instrument.
And the success of the new auditor's report will certainly be independent, that all stakeholders in the financial reporting supply chain are embracing that change, and every one of the panelists has made that clear. But how can directors prepare us and auditors be encouraged to embrace the new audit report? Linda, you again? Start.
I will start from the perspective of my day job as a non-executive director, maybe and an audit committee chairman. And I believe there's huge benefit for directors of companies because at the moment there is already a lot of communication between auditors and the audit committee, or as the ISIS refer to it as those charged with governance. And that communication, in my mind, will be enhanced by this project because there will be very clear discussions on what the key difficulties are, the key concerns for auditors, and there's also a much larger level of transparency to the investor community, the shareholders now. Maybe not in every single one of those, as Dan mentioned, but on the most important ones. So it gives more and transparent information to shareholders. And in preparation, Michael, you asked about the preparation of directors and companies. I think to open up those channels and start communicating and start moving towards greater transparency, both on the side of the company, which would make it so much easier for the auditor to report, that's a significant benefit to the public interest.
Before coming then to the two standard centers, that's up to you.
Yes, I think what we've found, and I think what we'll find in Europe in a couple of years' time when it's rolled out, what we've found in the UK that it has been embraced by management. Initially, there was concern in the audit profession. I know when you go to the US, there's always considerations about litigation and what the impact of these changes. So once there's uncertainty out there, then people are reluctant to change. But what we found was how quickly the companies and the auditors gained traction. The first report that was brought out was actually adopted early, and that was Vodafone. And Vodafone, the management of Vodafone and the audit committee at Vodafone agreed with moving the auditor reporting forward and setting the pace. And the auditors of Vodafone went along with that. I know for a fact there was lots of discussion with regard to that, but quite quickly they felt that it was in the mutual interest of the company and of the auditor to provide the information. So that was the first thing. And then as we saw more and more disclosure being made, there was less reluctance to give information. And then there's the infamous, or famous, or infamous, whichever you want to look at it, the side of the fence, Rolls-Royce report from your own firm. And there, the boundaries were pushed again. And this was only 6 months after the first report had gone in. The boundaries were pushed again, and the findings of the audit were put. So what the auditor thought about where the policies were with regard to Rolls-Royce. And so very, very quickly there was more information given, and people were embracing it. And certainly on the two audit committees that I sit, it made our reporting as a company more informative, because we weren't having the auditors telling everybody about our company. So we were more forthcoming of what we wanted to say, and the auditors, of course, were complying with the audit regulations. So they provided that information. So I think very, very quickly things moved and moved on, and I am hopeful that this will. This was just in the UK when it was adopted early. I don't know whether other jurisdictions have found the same, but I think that this will happen in Europe as more the requirements come in a couple of years' time, and then it will get it will just spread. and I know the US, there are challenges in all jurisdictions, but I think once it starts and it gains momentum, then there's always a situation where ultimately the investor community asks why a company isn't doing it rather than why it is doing it. And so if you're not giving good quality information,